A very good afternoon to you all, friends. I, Sanjeev Singhal, Chairman, Committee for Member in Practice, welcome you to the 89th program for the Committee for Member in Practice in this council year. Today's topic is finalization of the financial statement, perspective from the management side as well as from the auditor side. And the second topic for today is forensic audit. We have two very esteemed speakers. We have CA Achal Jain, who will be speaking on the finalization of financial statements and will be giving the perspective from the management side as well as from the auditor side. And Arpinder will be talking about the forensic audit. Briefly talking about Achal, Achal is besides being a member of our esteemed institute, is a commerce graduate from Delhi University. He is practicing into assurance and the advisory services. And prior to joining the current firm, he has earlier worked with Walker Chindiok, Deloitte Haskins & Sell, and SR Watley Boyd. Achal has more than 14 years of post-qualification experience in accounting, auditing, and financial reporting. And he has also worked with the institute extensively with the Financial Reporting Review Board in finalization of their publication on Ind AS and has been a prolific speaker. He specializes in Ind AS, IFRS as well as US GAAP. He's been a member of the study group of the Accounting Standard Board. He's also a technical reviewer with the FRRB. And I welcome him today's program. And thank you so much, Achal. Arpinder will be joining us shortly. Arpinder is a partner and global markets and India leader with the EY Forensic and Integrated Services practice. He has over 25 years of experience in global investigations, dispute advisory, and corporate governance matter. He is one of the few experts in India who was previously an internal auditor, statutory auditor, financial controller, and now leads the forensic investigation. He has also been a special invitee in the ICI Digital Accounting and Assurance Board. We welcome both the esteemed speakers, and we are sure that that our members will be immensely benefited on both the topics. The first topic is relevant because now the financial statements will be prepared by the management in 2 months from now for this financial year 21-22, and then the auditors will be doing this audit. So Achal will enlighten us on the important consideration in the finalization of these financial statements. And forensic is a very emerging and very important area. So Arpinder will be talking about the forensic. With this, I welcome Achal and hand over the screen to Achal. Over to you, Achal.
Thank you so much, sir. And thanks to all of you for joining this session. So as mentioned by sir, that today we are going to discuss about the finalization of financial statements, wherein we are going to consider both the perspectives about the management as well as the auditor. And this topic is such that this brings in a lot of perspectives, whether it is about the accounting standards or whether it is about the auditing standards or whether it is about certain compliances which are required for the finalization of financial statements. So that's why, we have a lot of ingredients to discuss today. So I've just put together certain thoughts on the basis of my experiences, which I'm planning to share with you. And the idea is to just, get on to those pointers to understand as to how those things which are really troubling some of the companies in terms of finalizing their financial statements, or maybe there are certain areas which are really impacting the companies or the auditors in terms of the review mechanism which they have been following, as to how we can just improve on those areas by looking at some of these considerations. So while we start with the finalization of financial statements, there are a couple of topics which we can say are mostly used. One is, of course, Ind AS 1, that is about the preparation of the financial statements, wherein we also bring in the requirements of the format, which is in the form of Schedule 3, which is again prescribed in terms of various headers, various presentation requirements which are required to be followed. And along with this, another standard which becomes extremely important happens to be financial instruments. we all understand that when the companies have moved from Indian GAAP to Ind AS, and most of the companies who are following Ind AS now, therein size of the financial statements is significant. And that is particularly because of the extensive disclosure requirements which Ind AS has brought along. And that is why these two standards become very, very important. And we can also say that one of the major contributors to the disclosures happens to be financial instruments. So that's why while we focus on the financial statements, one standard which definitely needs to be focused upon happens to be the financial instruments, which is available under three standards today: Ind AS 109, Ind AS 107, and of course Ind AS 32, wherein, as we understand, that Ind AS 107 is all about disclosures only, and which is again a very, very extensive topic, and which brings out a lot of disclosure requirements. So we'll just start a bit with some of the requirements of the financial instruments as to how these are really impacting the financial statements, and what are some of the considerations which the management definitely needs to consider, and which the auditor also needs to bring about while planning the audit procedures. So there are certain areas in respect of financial instruments, though this standard has got established quite a while now, but still, when we observe the presentation of financial statements, there are certain areas which are generally found to be missing, happens to be on the presentation of financial assets, presentation of financial liabilities. Just to give you a few examples, prepaid expenses, which happens to be a non-financial asset, is found at times to be an item of financial asset. Similarly, there are certain areas, there are certain captions which should definitely come under financial liabilities, and which are, instead of showing under current financial liabilities, they are shown under non-financial liabilities. So that's why what has generally been observed, that a clear marking of what is a financial asset and what is a non-financial asset, or what is a financial liability and what is a non-financial liability, is at times missing while finalizing the financial statements. Yeah, so I'll just give you a brief overview about a financial asset. So what is a financial asset? We can say when we have receivable in the form of cash, and which is arising through a contractual right. Okay, just to keep it very, very simple, this is something which will lead to a financial asset. So until and unless we have a contractual right, an asset will not become a financial asset. Now, considering this point, there are certain assets which will never fall under the category of financial assets. For example, prepaid expenses, we talked about, then the assets in respect of the taxation, whether it is about income tax or whether it is about indirect taxes like GST, etc., they will never fall under the purview of financial assets. Yeah, so that's why it's very, very important to consider all of these areas as to which all items should go under financial assets and which all items should go under non-financial. Similarly, when we talk about the financial liabilities, herein we can pick up an example. Generally, there are practices in the companies, whether it is about large corporates or it is about medium corporates. What we see is that the documentation in respect of the loans which are given by one company to another company. If let's suppose a group company has advanced a loan to another group company, generally the documentation around this is missing. And generally there is a consideration to consider this type of loan as a non-current item. And the rationale is very clear that the management doesn't intend to receive it. So that's why they are considering this to be a non-current asset. But if we look at it from the perspective of the company which has taken this loan, now for this company, the loan is something on which interest is not getting paid. There's no term as around as to when this loan has to be repaid. Means if we look at the holder, or if we understand the transaction, this can become repayable at any point of time, if that is at any point of time demanded by the holder. So that's why ideally what should this company which has taken the loan do? They should show it under a current liability. But again, this is an area which we generally find that which is shown under non-current liabilities. Yeah. Now there are a lot of thoughts around it, and the thoughts generally are to consider this to be a non-current liability so that the current ratios don't go bad. But this is something, and these are some of the areas wherein the auditor also needs to be very, very careful. So whenever we come across these areas, we need to ensure that there's a proper documentation from the management side. And if the documentation around this aspect is missing, then definitely we cannot consider the management perspective as around that the document is missing. So that's why we can just simply keep it under non-current liability instead of taking it to a current liability. Now, another point which is in respect of financial instruments happens to be around the investments in the equity instruments. Financial instruments, Ind AS 109 gives us an option that in certain cases wherein the investments are given or where the investments are made in equity instruments and which are not trading in nature, those can be designated by the holder. Those can be designated by the holder at fair value through OCI. Otherwise, all of these investments in the equity instruments, they will always go under fair value through P&L. Now, what is the impact? If we put it under fair value through P&L, then any sort of fair value change will go to the P&L. That will keep hitting the P&L. So just to avoid that situation, standard gives an option to the holder, and the holder, let's suppose, avails that option and designates all of these investments in the equity instruments, let's suppose at fair value through OCI. Now, because this is an option which is availed by the holder, so that's why there are certain important disclosures around it. Now, let's suppose there is a company which has been doing this, which has been presenting these items in the financial statements. Now, it becomes important for this company to give appropriate disclosures around it. Means, what was the thought process? How this instrument, which should have gone under fair value through P&L, has actually got classified under fair value through OCI. And this also happens to be an accounting policy choice for the company. So that's why it's also important to bring out the accounting policy in respect of this. And let's suppose if that aspect is missing, then definitely it's an important disclosure which cannot be ignored. Now, this is again one of the area where the auditors need to focus on. Another aspect around the financial instruments happens to be around the ECL. ECL is all about creating a provisioning in respect of the financial assets. And just to keep it very, very simple, we can pick up the example of trade receivables, because this is an item which requires provisioning from the ECL perspective. Now, unlike the approach that we used to follow under the previous GAAP or the Indian GAAP, Ind AS requires specifically that each and every trade receivable has to be evaluated from the perspective of ECL approach, wherein we need to expect any sort of loss which may arise on those trade receivables. So let's suppose if there is a trade receivable which is only 1 day old, even that may require provisioning while considering this ECL model. But here again, what is generally observed in case of financial asset, in case of financial statements, that this aspect in respect of the debtors, or you can say the trade receivables, which are current in nature, or you can say which are only 30 days old, or which are just say 60 days old, generally the management doesn't consider them from the provisioning perspective, because again, the same approach is being carried. But this is something which is very, very important for the management to consider, because now we need to understand as to what is the expectation of the management as around these trade receivables which may become bad in future. Let us again take an example to understand this situation. Say, for example, we have trade receivables in the age bucket of 0 to 30, 30 to 60, 60 to 90, and then 90 to 180, and so on. Let's suppose management has a perspective that any trade receivable which is 90 days old is not bad. Why? Because this is something which is in the normal course of credit term which is allowed. Now, herein, the aspect which the management needs to consider is that if they are considering a provision in respect of debtors which are, say, more than 90 days old, and they are also expecting some sort of loss over there, then all of these debtors which have moved to 90 days and the greater than 90 days category, they were also at some point of time within this bucket of 0 to 90. So all of these 0 to 90, which were good at one point of time, they became bad later, isn't it? Now, this is one aspect which the standard requires us to consider. So that's why we can't just ignore this aspect that this is something which will not require a provision. Secondly, this standard also requires us to consider the time value of money while creating the provision. This standard suggests that if the credit term which we generally allow happens to be, say, 60 days, but what we understand from the customers is that they always pay us, say, within 120 days or say 90 days. So there's some time value of money which we have been losing out. Why? Because of this delay which they have been making every now and then. And this is a kind of practice which can also be considered to be customary in nature, but this is something which is a loss to the company because this is against the contractual term between the company and the customer. So this standard also requires the management to give a consideration on this factor and accordingly create a provision for this. Now, these are some of the aspects which are required to be analyzed carefully by both the management as well as the auditor, and on the basis of which this standard requires us to create a provision matrix. Now, this provision matrix, again, at times it becomes a problem because let's suppose if a provision matrix is established in a particular year on the basis of which management has created a provision. Now, this standard requires that this provision matrix also needs to be reassessed every year. So it's not that if a provision matrix has been established, so this will continue forever. No, this is again something which is more of an estimate. And because this is an estimate, so that's why it will require revaluation on the part of the management, and which is also required to be appropriately audited by the auditor. And the auditor also needs to understand the assumptions which the management have considered in considering all of these provisions and why these are not changing over time. So these are important considerations on the part of the management as well as the auditor. And herein, we can't just simply say that any of the trade receivable which has become bad has been provided for, and that's why adequate provisioning has been taken, can be considered as a good you can say argument from the management. That is not acceptable. Next aspect around this financial instruments, I would say, is around the derecognition of liability. Over the last few periods, we can say this derecognition of loan has become quite common in terms of the restructuring which has been taking place in respect of the defaults which the companies have been making, or in respect of settlements which the companies have been making. Now, this aspect again is clearly guided by the standard. Standard provides an appropriate guidance as to how this needs to be assessed, whether it is about a modification of a liability or whether it is about extinguishment of a liability. And what has also been observed that both these aspects are duly taken care of by the management as well as the auditor. But along with this, another very important area happens to be the disclosures as around any of the treatment which has been done in the financial statements. Now that becomes very important. Now that is one area which is generally seen as ignored by the management while finalizing the financial statements. And that is one area which again is very important for the management to consider, that whenever they have been following any accounting policy in terms of considering any of the loan change, whether it is about modification or the extinguishment, as to what is the approach they have been considering, why they have been considering, and what is the impact around it in the financial statements. Yeah. These are some of the important areas as around the recognition and measurement changes, which we can say arise from the requirements of financial instruments. Along with this, another important consideration in the financial statements happens to be around the statement of changes in equity. Now, this is a separate statement which goes into the financial statements, which is a key component of the financial statements. And for this component of equity, we have a comprehensive guidance available under Ind AS 32. That is again on the financial instruments. Now, generally, it's been found that this assessment of equity in respect of various instruments which the management is having is not clearly given in the financial statements, whether it is about presentation in the statement of changes in equity or whether it is about giving the disclosures around that assessment of equity. Let us try to understand this aspect also, because I would say this happens to be a very important area in respect of financial statements. And this is also something which becomes contradictory to the legal requirements at times. So let me just explain this point to you. Now, currently, if we look at the preference shares we can say is the share capital of the company. And if we talk about the debentures, we can say debentures are nothing but the borrowings of the company, or it's a kind of liability for the company. So now, if we look at the legal nature of both these instruments, preference shares will say is something which is in the nature of share capital, and debentures are in the nature of liability for them. But we also understand, using the guidance of Ind AS 32, that even though legally these instruments may be considered as share capital or the liability respectively, but as per the accounting standard, that means Ind AS 32, it may not be the way we treat it. For example, if we talk about redeemable preference shares, now considering the guidance which the financial instruments provide us, can we consider redeemable preference shares as the capital? No, they will clearly become the liability. Why? Because they have to be redeemed, and there's an obligation to pay cash in respect of these preference shares. So that's why, even though legally these may not be considered as the liability, but as per the requirements of accounting standard, these will be considered as the liability. Similarly, if we talk about convertible debentures in their legal form are considered as a liability, but because they are convertible, or you can say they are compulsorily convertible, that's why in respect of the principal amount which is convertible on the part of the debentures, we cannot say that these are liability on the part of the issuer. They will always be considered as equity on the part of the issuer. Why? Because there's no obligation to pay cash, and this is what the standard requires us to consider. And this is again very, very important consideration on the part of the management, that whenever there is an obligation on the part of the issuer which is unavoidable, to pay cash or to give the financial asset, in such a case, such an instrument should be considered as a financial liability. But whenever the issuer has got any sort of option to avoid that obligation to pay cash or to give the financial asset, and which is again something which is not in the nature of fixed for fixed, or which is in the nature of fixed for fixed, then it will always qualify for equity instruments. And accordingly, the classification of all of these items will have to be made in the financial statements. Yeah. Now, as around the financial statements, we can easily say that 60 to 70% part of the financial statements comprise of financial instruments. Let's try to understand how this will be contributing significantly to the financial statements. So now, in respect of each and every item which is there in the trial balance of the company, first of all, the first assessment which the management needs to do is around the understanding whether the asset or the liability is financial or non-financial. In respect of each and every item, this classification has to be considered. What is financial, what is non-financial, and if that is not a liability, whether it is equity or not. Yeah. So entire trial balance, this complete chart of accounts on the part of the company has to be assessed appropriately, whether that will become financial, non-financial, or that will become equity. Now here again, an important consideration on the part of the auditor is to review the chart of accounts. When we start the audit and when we start with the trial balance, generally there is an understanding that all of these classifications are appropriate, but all of these classifications may change over the period. And it may happen that an instrument which was into a particular classification bucket may change into a different classification bucket. So that's why this is an exercise which the auditor needs to repeat every year, every reporting period. This has to be assessed. Yeah, so we can't just simply take the same chart of accounts in terms of their classification and then move ahead. This will have to be revisited at every point of time. Yeah, even though this doesn't lead to significant changes, but still this exercise becomes very, very important. And let's also consider its impact. See, the moment this chart of account goes wrong, what will happen? The eventual presentation of that particular item in the financial statements will change. Yeah, the total that we present in respect of financial assets, in respect of financial liabilities, and the disclosures which are also linked to this classification, because the disclosure requirements for financial assets or the financial items are different as compared to the non-financial assets. Yeah, so if this classification goes wrong, we can also understand that the disclosure requirements will automatically go wrong. So that's why it's very, very important on the part of the auditor to ensure that all of these classification requirements are appropriately taken care of. Next aspect, as around the financial statements, I would say, is about the investments in the group companies. Now, in respect of investments in the group companies, what we generally consider is that these items are shown at cost. These items are generally shown at cost in the financial statements, because there again, we have an option available in the form of accounting standards which allows this, wherein we can keep it at cost, we can keep it at fair value, yeah, which is allowed, and which also happens to be an accounting policy choice for the company, which is appropriate. And we understand that most of the companies avail this, most of the companies use this. But as around this accounting policy choice which has been availed by the company, there are certain disclosure requirements. First, of course, is about the accounting policy. This accounting policy has to come out very clearly as to what has been availed and why that has been availed. Secondly, as around all of these investments, it's very, very important to ensure that the disclosures as around their consideration in terms of their measurement are also given appropriately by the management. Yeah, all right. Next aspect, as around the financial statements, I would say is about the estimates. Now we all understand what are estimates. Estimates, we can say, are those items which are based on approximations, which are subject to changes, or you can say which cannot be measured with 100% accuracy. If we have to take few examples around it, we can say useful life of the fixed assets. Under Ind AS, significant usage of fair value is required. Fair value is something which applies to so many items in the financial statements. And this fair value is what? It is again a kind of estimate. Now, all of these estimates are based on management judgment. So whenever management will prepare the financial statements, what do? They will make the estimates. They will make the judgments. And on the basis of their judgment, whatever estimates they will make the recognition in the financial statements, measurement based on that recognition. Correct? Yeah. Now, generally, what we have seen is that whenever the estimate gets involved in respect of any of the items in the financial statements, audit procedures around those estimates start getting decreased. Yeah, so if we talk about useful life of the PPE, yeah, let's keep it very simple in terms of useful life of PPE. Now, because there's a useful life of PPE which the management has ascertained, or let's suppose if they go by simply some of the lives which are suggested by, say, some of the requirements of the Companies Act, and some of these are assessed by the management. What are the audit procedures which the auditor have performed? Generally, these are found to be missing. And please remember that on estimates, we have a separate guidance in the form of auditing standard, wherein we need to ensure as an auditor that all of these estimates are appropriately audited. Now, what will the auditor do in this situation? Let's try to understand this. As around the estimates, the auditor needs to get into the assumptions which have been used by the management. It may also happen that as around all of these estimates, management has also involved an expert. For example, we can consider actuarial valuation. Actuarial valuation is also an estimate, and which is not assessed by the management. Management will always hire an actuary. On the basis of the report of the actuary, the actuarial valuation is recorded in the financial statements. Now, as around this actuarial valuation, management is fine as far as that working of actuary is concerned. Why? Because management would have duly ensured that the actuary was competent enough on the part of the management. Okay, management would have assessed this, and management would have considered that for the purposes of the valuation to be recorded in the financial statements. But for an auditor, now it becomes very important, and auditor cannot be limited to just taking the actuarial certificate as the documentation for closing this audit procedure. No, that cannot be the acceptable procedure on the part of the auditor. As around any of these estimates, what is important? First of all, auditor needs to evaluate whether the expert which the management has hired, whether the expert which the management has involved is competent enough to do this job or not. Yeah, so that means this evaluation, even though this has been done by the management, auditor also needs to evaluate independently. Number one. Number two, considering that the expert of the management is competent, the next thing will be to ensure that whatever work that expert has performed is also duly checked by the auditor. For example, when it comes to the actuarial valuation, there are three things we can say will form part of audit procedures. One, the data will go to the actuary. Second, on the data that the management will provide to the actuary will do some processing. and will provide the valuation. And third will be the actuarial certificate, or you can say the report of the actuary. Now the first part, that means this data, the information which is processed to the actuary, which is sent to the actuary by the management, is something which is very, very important for the auditor to verify. It is important for auditor to check that the right set of information is sent to the actuary, because this will become the basis for the actuary to compute the valuation. And if this valuation is not appropriate because of the data which was sent to the actuary, this is something which needs to be taken care of by the auditor, of course by the management, but as an auditor we also need to ensure this. Secondly, as around this information which is sent to the actuary and on which the actuary will perform certain procedures, actuary will use some assumptions. See, every valuer will consider certain assumptions. Some of the assumptions we will discuss with the management. For example, I would request the team to just keep on mute, please. All right, thanks, sir. Okay, now as around the data which has been sent to the actuary, now the actuary will use some assumptions. In respect of these assumptions, some of the assumptions actuary will discuss with the management. Now the actuary will discuss with the management, for example, the mortality rate, for example, the attrition rate, for example, the increment percentage, which will become the basis for the computation of the valuation by actuary. And some of the assumptions actuary will use. Some of the assumptions which the actuary will use happens to be the discount rate. Yeah. But as around all of these assumptions which the actuary will use, it is important for the auditor to analyze it, to evaluate them, whether all of these assumptions are appropriate or not. Auditor needs to discuss this with the management as well as with the actuary if required, and the auditor needs to challenge all of these assumptions. Once these two set of procedures are performed, then of course the third set of procedure is about taking the report of the actuary in terms of the final documentation, which is fine. But just if we just stay limited to taking the report of the actuary and that becomes the basis of closing of the audit procedures, that cannot be considered to be the right approach by the auditor. And similarly, whenever any sort of valuation is involved, any sort of estimate is involved, it is very, very important on the part of the auditor to ensure that all of these assumptions, all of these bases of estimates are appropriately audited by. Yeah. Now, whenever it comes to the audit documentation, now I'm just thinking it more from the perspective of the auditor, because for an auditor, this is a very, very important area. Now, from the documentation of the auditor, it becomes very, very important that what are the set of procedures that he would have performed in respect of estimates. These days, if we talk about the reviews, the focus of the reviewers are generally on some of these areas. Yeah, because these are generally those areas which are ignored by the auditors. Second aspect, there again, I'm just focusing more on the audit side, that is about using the work of expert by an auditor. Over here, what we have discussed so far was about the expert of the management, which the management has used, and how the auditor will get into those assumptions, get into discussions with those experts, and will apply audit procedures in respect of the working of the expert. There could be certain areas, there could be certain items in respect of the financial statements over which auditor or the engagement team may not be competent enough to do the audit. Means in respect of those limited areas in the financial statements. Therein, it becomes very important on the part of the auditor to bring in his own expert. therein the auditor cannot say that because he is the one who is the part of the audit team and the engagement team, they are going to stay limited to the audit procedures, or they will be the only persons who will be following the audit procedure. There are any sort of specialized areas which will require the involvement of an expert, even though the management may have involved an expert already for that part of procedure, or already for that part of working inside of the financial, in respect of the financial statements, it also becomes important for the auditor to bring in his expert to audit that area. For example, in respect of certain industries, inventory stock take, or you can say the physical verification of inventory, is not something which is a very simple exercise. For example, if we talk about the steel industry, now in respect of steel industry, the kind of inventory which they will be having is not something that we can just go and check all of those items and do the physical verification. No. And in respect of the inventory which is sitting in the financial statements, physical verification happens to be an important procedure on the part of the auditor. From the management side, management would generally be an expert for their physical verification. Why? Because there's something which is related to their business. So they may also be involving certain experts to do this exercise. But as regards the auditor who will be involved in respect of these areas, if the auditor believes that a separate technical expert is required or a separate expert is required, then the auditor needs to bring in that expert who will be working along with the audit team or the engagement team and get into that particular procedure. Now, as around the involvement of the expert of the auditor, we can't just simply say that because the expert has been involved, so that's why the job of the auditor is done. No. See, eventually, when it comes to the audit, who carries the responsibility for the opinion on the financial statements? So the audit opinion responsibility lies with the audit team, or you can say the audit partner. So that's why even though the expert by the management or the audit side is involved, eventually the responsibility is something which lies with the auditor. So that's why they need to ensure that even though all of these experts have been involved, still the work which these experts would have performed is also something which the auditor would have looked into and would have considered as around their impact on the financial statements. Clear? Yeah. So these are some of the important areas, I would say, which are pertinent and which are generally found to be missing when it comes to the audit of the financial statements. Another area in respect of financial statements, and with this Ind AS coming into picture, which becomes all the more important, happens to be the prior period items. Now, under earlier GAAP, when we used to finalize the financial statements under Indian GAAP, it was okay to have the prior period items, and whenever those prior period items were noticed, those were recorded in the financial statements of the current year. What are the prior period items? Any item which relates to the previous years and which was for some reason not recorded in the financial statements of the previous year. And that could have been intentional or unintentional. But now, under Ind AS, this consideration has changed. This treatment has changed significantly. Now, under Ind AS, if there are prior period items and if those happen to be significant, then these cannot be recorded in the current year's financial statements when those are found. No. What is required now? Now the requirement is to restate the financial statements of the previous year. And by restatement, what do we need to do? We need to go back to the previous year. That means we'll have to change the comparative year if that relates to the previous year. And if that relates to any year prior to the previous year, then we need to go back to that particular year and change the change the numbers in that year, and then bring out its impact on the opening results. Yeah, so this is something which is required to be done as per Ind AS. Now, whenever we do this, this is called as restatement, wherein while finalizing the financial statements, while presenting the financial statements, we need to specify clearly that it's the restated balance sheet, it's the restated P&L in respect of the previous year. And Ind AS also requires to bring in one more balance sheet, means over and above the comparative balance sheet, if there is a restatement which is related to year which is prior to the previous year, then we need to bring in one more balance sheet with the changes that would have taken place over there. And all of these items are then also required to be disclosed in the financial statements. Means, what were those prior period items? Of course, there would have been errors. So why those errors have taken place, and what is really the impact in respect of those errors in the financial statements? Generally, we see a note in the financial statements that previous year figures have been regrouped or reclassified wherever necessary. Yeah, it's a very, very common note at the end of financial statements of any company. You will see this. But when it comes to the Ind AS, any sort of reclassification is also a prior period change, which will also require this restatement to take place. So that's why we need to be very, very careful in terms of ensuring the accounting of a particular period, and in case those changes are arising in the next year, how significant those are. And there again, the materiality factor will definitely have to be considered by the management as well as the auditor. Next aspect, which becomes extremely important while finalizing the financial statements, happens to be the materiality. And this is one area I would say which is very, very important. Now, what is materiality? Materiality means a threshold, or you can say such an impact which can have an impact on the decision making of the users of the financial statements. Means, if there is an impact in the financial statements and is of such size, such nature that it can impact the decision making of the users of the financial statements, then it is considered to be material. This is considered to be significant enough. Now, materiality is something which is very important to finalize the financial statements. See, when it comes to any company, whether it is about small company, medium company, large company, errors are going to arise. And there are certain errors which definitely cannot be taken care of within that particular financial year. At times, it is required to close the financial statements. Now, therein, management needs to draw a threshold. And this threshold has to be drawn on the basis of materiality. How do they decide the materiality? Now, for materiality, certain benchmarks are available. Generally, we consider profit or loss as the benchmark for considering the materiality, means how significant this impact is going to be there on the P&L of the company. In certain cases, wherein the P&L is volatile, means the profits or losses are not consistent in nature, revenue can become the basis for considering the materiality threshold. In certain cases, when it comes to a startup with the which is not having any profits, or say not really having any revenues, therein some of the considerations around the materiality could be the assets also. Now, the important point for us to consider as around the materiality is that threshold, below which if something is ignored by the management, then that will not have a material impact to the financial statements. And same is the approach which the auditor needs to consider. So while finalizing the financial statements, it is very, very important for the auditor to determine the material. And materiality is something which is required to be determined by the auditor before really starting the audit. Means at the planning stage itself, auditor needs to determine this materiality. And once this materiality is determined, this is not something which is going to stay unchanged throughout the period of audit. No, this may change depending on the impacts which may arise in the financial statements of the company during the course of the audits. That means this is something which will have to be re-evaluated, or auditor needs to just keep doing this assessment. So this has to be a continuous assessment throughout the period of audit. Why is this important? Because when it comes to the finalization of financial statements, there are going to be certain areas which are not going to be very significant, which are definitely an error, but those are not material errors. Those are not significant errors. And that's why it's very important for both management and auditor to consider those errors. And at times, they may also consider ignoring those errors if those are not material enough. If that doesn't have any impact on the financial statements, and if that is too low a number to have any impact on the financial statements. Yeah. So this is something which can also help the auditor to get closed in a faster manner, because this is something which is within the threshold of the management and which is also within the threshold of the auditor. Another aspect which I would say is important from the auditor's consideration happens to be the representation. And this is something which has been observed as a significant problem in terms of the audit procedures being performed. Many a times, what do we see? That if a particular document is missing with the management, or management doesn't have the appropriate explanation in respect of any item, what do? They will just simply say that this is not a problem, we will give a representation for this. Means this is something which the management has done and will confirm this and will give this in writing. Why? Because the management is required to give management representation letter, and they will be happily presenting this point in the representation letter. Now, it is important for the management as well as auditor to consider that when it comes to the audit procedures and when it comes to any of the area which is important for an auditor, management representation cannot be the conclusive evidence. Without performing the audit procedures, or you can say just by taking the representation from the management, or by taking only the representation from the management, auditor cannot close the audit. Auditor cannot just say that his audit procedures are completed. That will not be appropriate. There's no doubt that once the audit procedures are completed, management representation has to be obtained by them. So this is something which is an add-on to the audit procedures of the auditor. But on a standalone basis, auditor cannot just simply say that the management representation has been obtained and this is good enough for the auditor to say that this is sufficient as well as appropriate audit evidence. No, this is not something which is acceptable on the part of the auditor. So that's why, in respect of all of these areas, it's very, very important. It's very, very important on the part of the auditor to take care of all these areas. And if there are any such areas, discuss that with the management and also explain them the perspective that this is something which cannot be considered as an accepted practice. And that's why management will have to provide appropriate evidence, and which is not limited to the verbal representation which is given by the management. Another aspect which is again important to be touched upon in respect of the finalization of the financial statements, and something which is which significantly impacts the closure of the financial statements, be it any audit, be it a medium company or a large size company, and that happens to be around the audit procedures related to external confirmations. Now we all understand that there are certain areas, for example, banks, for example, borrowings, for example, debtors, for example, creditors, in respect of which auditors roll out independent balance confirmation to the parties. In respect of banks, in respect of borrowings, what do we see? We see that the auditors roll out independent balance confirmations to, in fact, all the parties. In respect of debtors, in respect of creditors, what do we find? That all of these confirmations are rolled out on a sample basis. These are not rolled out to all the parties. Therein, it becomes very important. It becomes very important on the part of the management as well as the auditor to discuss this audit procedure before really starting the audit, and also to discuss the timing of this audit procedure as to when this audit procedure has to be timed, so that this can also get completed. Because in respect of this audit procedure, there's a dependency of both these parties on a third party, because management as well as the auditor don't have to share information amongst themselves. They have to obtain this information from a third party, and which at times is not really in their control. So that's why it's very, very important for them to ensure that all of this information is obtained from the third parties in a timely manner. And that's why timing of this audit procedure becomes very important while finalizing the financial statements. And in respect of this exercise, and I'm sure many of you would be able to relate to this becomes very, very difficult at times to track all of these confirmations and to obtain all of these confirmations, and to get onto a stage wherein these confirmations are obtained, or we get onto a stage wherein these confirmations are not really obtained, and then to take an approach as to what is going to be an alternate procedures. Now this is again very important, because on the basis of this exercise which the auditor will initiate, and after observing a certain period of observing this procedure over a certain period of time, it becomes important on the part of the auditor as well as the management to decide whether they will be able to get these confirmations or not. And in certain cases wherein they believe that this procedure will not be completed the way they want, it will be appropriate for the auditor to get on to the alternate procedures. And also it becomes important on the part of the management to agree on the timing of this alternate procedure, because otherwise what may happen is they may delay the start of the alternate procedure, which the management can definitely anticipate, because management will be well connected with all of these parties, so they will have an insight as to who is going to respond, who is not going to respond. So that's why it's very important on the part of both these parties to plan this particular audit procedure. Yeah. So I think these were some of the thoughts in respect of the finalization of financial statements, which I thought are really important. There are definitely going to be more considerations, and I'm sure you would have also seen many more situations in respect of finalization of financial statements. But these are some of the areas, if we really focus upon, then this can definitely help us streamline the finalization of financial statements, and also completion of the audit of that finalization or audit of that financial statements. So I think with this, I would just like to end my discussion and thank you all for your time and for your participation in this session. Thanks to you. Thanks so much.
Thank you so much, sir. Can you hear me?
Yeah, sure. Thank you so much.
Thank you so much, sir, for such a nice deliberation. So there are 2-3 questions for you.
Sure.
So first question is this: can UDIN for company audit be generated after AGM date?
See, UDIN is something which has to be generated on the date when the financial statements are getting signed and the audit report is also getting signed.
Yes, sir.
So when we say that this can be generated after the AGM date, it's a kind of delay, yeah, which I won't say is an accepted practice. So I would always recommend to generate the UDIN on the day when you are signing the audit report. But at times, if for any administrative reason this could not be generated, then of course we have this time window of 60 days available to us within which UDIN can be generated. But I would not recommend that.
So there's another question. Please explain how to check asset or liability is financial or non-financial.
See, as around the financial or non-financial, we can just keep it very, very simple to understand this aspect that when it comes to the asset, we need to check whether there is a contract against which there will be a right to receive cash. So if there is a contract through which we can receive cash in respect of the asset, then it will become financial, other non-financial. In respect of liability, if there is a contract through which there is an obligation to pay cash which cannot be avoided, then it will become financial liability. Otherwise, it will not be a financial liability.
Whether we need to give the verbal statement given by management in notes?
Definitely, inquiries will form part of the audit procedures, but this cannot be the standalone audit procedure. Means over and above inquiries, some substantive testing has to be done. Whatever we have inquired from the management, we also need to get into the underlying document and we need to validate that all of these discussions, all of these confirmations which the management has explained verbally are getting substantiated by the supporting documents on.
Sir, how do we get the master list of related parties?
Sorry, what's the query?
How to get the master list of related parties?
Now, this is definitely a challenging area, I would agree. Now, to get the list of related parties, I think the biggest problem for the management as well as the auditor, so this is not something which is limited to the auditor, happens to be ensuring the completeness, whether the list is complete or not. And that's why an extensive exercise is required to be performed. As regards the management, they know their business and they understand the parties with which they have been dealing. So that's why I would say management is in a better position to check whether all of these parties have been covered or not. First thing, of course, will be to get into a detailed assessment of the group companies if we are belonging to a particular group, and to analyze each and every company which falls within the group with the requirements of various Ind AS. Then we also have certain requirements of the Companies Act which requires the way related parties are required to be considered. So that will also become the basis. We will also involve our secretarial team, which will also help us in this exercise in evaluation of this related parties. Yeah.
Yes, sir.
So all of these, I would say, has to be done along with the team. And therein, I would say, when it comes to the audit, it becomes very, very important for the auditor to have this discussion with all of these team personnel as to how they have ensured the completeness to ensure the completeness of the related parties.
Yes, sir. So thank you so much, sir. These were the questions for getting to your deliberation, and that was the wonderful deliberation. And you are justified with your time and deliberation, and explained various points relating to the same. And we have gained a lot through your deliberation. On behalf of CMP of ICI, as well as on behalf of all the members, I extend my heartiest thanks towards you for sparing your valuable time and enlighten all of us. Thank you so much, sir. Thank you.
Sure. Thanks. Thanks.
Thank you.
Thanks.
Moving towards our next session, that is related to the forensic audit. We are having with us our next speaker, CA Shri Arpinder Singh Ji. On behalf of CMP of ICI, I extend my warm welcome to Arpinder Ji. Welcome, Arpinder Ji.
Thank you so much. Really appreciate that.
Thank you so much, sir. And again, today's very important topic is the forensic audit. And this topic is very relevant and very apt in today's era. And we are having with us the eminent speaker, Arpinder Singh Ji. It is my proud privilege to share all of you the brief profile of Arpinder Singh Ji. Arpinder Singh is a partner in global markets in India, leader with E&Y Forensic and Integrity Services. He has over 25 years of vast experience in global investigations, dispute advisory, and corporate governance matters. He is one of the few experts in India who was previously an internal auditor, statutory auditor, financial controller, and now leads forensic investigation. He was a special invitee in Institute of Chartered Accountants of India's Digital Accounting and Assurance Board (DAB) for the year 2020 and 21. He has also served the institute by deliberating on various VCMs, webinars, seminars, etc. So, without wasting much more time, may I request Pinder ji to please deliberate on the topic forensic audit and enlighten all of us on various activities on this forensic audit. Over to Pinder ji, please.
Absolutely. Anilji, can you see this presentation which I have?
Yes, sir. Yes, it is visible, sir. Kindly make it full screen. Yes, now it is fine, sir. It is full screen, sir.
Okay, thank you. Thank you so much for the introduction. Hopefully, I'll make up for it. So, welcome to everybody. Hope everyone is keeping safe. I think that's the most important thing in today's time and age. So I will share whatever I know about forensic audit in the next 45, 50 minutes that have been allotted to me. Obviously, this is what I've done for the last 17, 18 years. Very exciting times for a forensic practitioner in India, forensic accounting practitioner in India. Obviously, being an auditor, everything starts from an audit. It was interesting to hear the previous speaker talk about related parties. I'll just make one comment on that before I start. When the question was asked about related parties, one way to find that is actually there are many tools out there where you can run a script to get connected parties. And if you remember in the insolvency and bankruptcy code, there was a whole process to identify related parties or connected parties. So there are Google links, there are tools out there where you can actually put in names of individuals, names of companies, and see a whole web of linked entities. So if you as an auditor want to independently validate related parties, there are many tools out there which you can today subscribe to or validate. And it's good. You must do it for your own knowledge, if nothing else, because one is to rely totally on the management. But if you feel there is any suspicion or there's anything you want to cross validate, and even for your own knowledge, please go there. If you need any information, I'm happy to offline share a few links with you. But you must see how related parties are identified and how you can find out more around them. Anyway, coming back to my topic, I will cover today a little bit about why is fraud so important in today's day and age. It's the awareness due to media, social media, digitalization, WhatsApp. People are talking about fraud all the time. Everyone, there are a lot of social conscious people out there who are raising issues all the time. Even as auditors, I'm sure a lot of companies which do audit or firms which do audit get whistleblower complaints directly saying that, we feel there's fraud happening in the company. You are an auditor. Please look at it. So there's so much evangelism happening there. I think this has become a very topical topic. Also, there's a lot of comfort in blowing the whistle. I find more and more whistleblower complaints are coming. In the last 2 years, at least, I see a significant increase in whistleblower complaints in the companies I advise or I work with. There's a lot of regulatory intervention. You constantly hear of very senior people potentially being arrested, a lot of action, raids happening by different enforcement agencies, whether it's Enforcement Directorate, CBI. So I think as auditors, it is very important for us as accountants to be aware of the scrutiny the regulator is doing. And now when you go in for questioning with the regulator, the question is, did you do the right thing? Did you ask the right questions? Did you look at everything? And you can't sometimes hide behind a scope limitation. You have to ask the right questions. There's a lot of common sense in it, and if they're very basic questions you can't get an answer to, there's something which doesn't smell right. Another thing is the fear factor on rise among defaulters and fraudsters, because the government is very aggressively going after any sort of defaulters, willful defaulters. So it's not, if you remember 15, 20 years back, you take a loan and you can forget about it. Today, there's a lot of governance, there's a lot of scrutiny, there are a lot of regulators who are going to come after you. And that's why the reporting and our responsibility as accountants even increases further. There's a lot of channels to report. You have social media, WhatsApp, you can blow the whistle through a normal hotline. There are many ways of blowing the whistle. But the whole approach in fraud and forensic audit has moved to being reactive to proactive. What I mean by that in a very simplistic way is, earlier, whenever you got a whistleblower complaint, you had to investigate it. Today, companies and boards are saying that, is there a fraud risk assessment? Is there any proactive work which has happened in a company to identify fraud risks? Are fraud risk registers maintained? Is the company doing anything proactive on a training perspective or anything? So people have moved away from just waiting for an incident to happen or an accident to happen, but they are also checking, are you actually testing the systems? Are you testing the controls of the company? Are you comfortable with the fraud risk environment which has been created in a particular company? And I think every company, there was a perception earlier that multinationals had a lot of good corporate governance, but today I would say most companies are treating corporate governance very importantly. A lot of independent directors are there. I think there's a lot of increased governance, especially after the Companies Act. And I think the Institute has done so much awareness and training themselves. I think that whole environment and ecosystem, if you ask me, the first question they ask is not so much about business, but is the corporate governance of a company adequate? Moving on, what is the current environment? The current environment is that you have a lot of issues around NPAs, especially in the banking sector. There's been a lot of cases we read about in the newspaper every week, which talks about a particular fraud which has happened, whether it's 50 crores, 100 crores. The amounts are pretty large in many instances. In the recent statistics which RBI released, of course, it showed a slight dip, but in my mind, if you take the last 3-4 years, there's been a significant increase in the fraud reported as per the RBI reporting requirements. If you look at shell companies, the whole question on related parties comes in. What are these transactions with third parties where there's no Chinese wall, or there is no proper governance between the transaction between two parties which could potentially be related? That people are being arrested for these bad practices, governance. If you signed off on a document today, a signature is extremely important, and we as accountants do know the importance of it. When we sign a document, you have to stand behind it. And I think that's where the criticality of fraud comes in, because fraud is the one area where you don't get reprimanded or you don't get a letter in your file saying do a good job next time. When a fraud happens and you signed a document, you will go through a lot of challenges for the next few years on that one document. So I think it's very important to do that. Of course, SEBI has put in a lot of requirements for listed entities, as we know, with the SEBI LODR and fraud reporting, which I'll go into some detail on. So there's so much happening, and if you take the 4 areas: fraud, bribery and corruption, antitrust, money laundering, just general misrepresentation, I think there's so many areas which are coming in. Of course, you have new age things like cybercrime, ransomware attacks, data privacy. Those are also things which lead to forensic type of audits. But today I will keep my topic more for financial statement fraud for the purpose of for the community we have currently on the phone. Now, what do I see, as a practitioner of doing forensic audits? What do I care about? It's the regulations, right? At the end of the day, you have to do forensic audits within regulations. Obviously, a lot of forensic audits happened in the last few years because of NPA loans. A lot of them happened because of insolvency and bankruptcy code, which talked about, they didn't use the word forensic or fraud investigation, but they did a look back for 2 years. But basically, it was like a forensic audit where you looked at related party transactions, you looked at suspicious transactions, you had to categorize transactions in 4 buckets. I think the good part was that it forced a lot of practitioners like us to say, okay, is this a fraud? Is it a misrepresentation? Is it a preferential treatment transaction? So I think that's the good part which these parameters put on you, is that it makes you more focused. It put some parameters on what report you're going to be issuing, because historically a forensic audit report, every firm could have a different format. Every firm could have a different version. But I know a lot of the banks have now started prescribing formats for forensic audit. So there is a proper format by different banks, large banks especially, which says that you have to give a report in this way. As I mentioned, the IBC actually prescribes what are the 4 categories that you have to report under. So there's a lot more prescription on a forensic audit than there used to be in the past. The Institute of Chartered Accountants itself has done a great job. I don't know all of you have read these standards. They've been put under 6 groups. I think that group did a really good job of coming out with the standards. I think currently it's very important for all of us to read it. If you're a forensic practitioner or even an auditor and a fraud happens, I think it's a very good guidance for us to keep in mind as we do these forensic audits. Because if we don't follow those principles, then there is no consistency. We can be called and we can be questioned why did we not do a particular procedure, or why did we do a procedure. Now that we have these accounting standards, I think they're a very good guide for us as forensic audit practitioners to look at in that sense. There's also a guidance note, which I do refer to a lot by the Institute, which talks about reporting fraud. And I think that's also a very well written document I would recommend all of you to look at. There are many other regulations which are coming out, like the SEBI's LODR. It caused a lot of confusion in the last few, I would say, year and a half. And there was requirement about disclosure of forensic audits. In fact, there was some impression that all whistleblower complaints that's received by a company and forensic reports around those whistleblower complaints need to be disclosed to SEBI. And that caused a lot of churn because some whistleblower complaints are small, some are slightly larger, but every case is not one which would impact the financial statements or one which would have a material impact on financial statements. So I think subsequently there have been some clarifications by SEBI on what should be reported, whether it's material or whether it impacts financial statements, etc. So I think you should look at that. Their website has a lot of that information already on it. But I think it's very important for us to have the knowledge around all these requirements. There's fraud reporting requirements by the RBI. So that is also something we should be all very clear about. Caro 2020, I think, has brought in a lot of focus on fraud. So, whether the fraud disclosure requirements, if you look at it, if you look at the left-hand side of my slide, talks about any fraud on the company, talks about any fraud by the company, any report by the auditor filed with the central government, whistleblower complaints, have you considered all of them? There are many dilemmas, actually. You make audit a company and they say, we have no whistleblower complaint. Do you think that's practical? I think it's very difficult. In today's day and age, if a company, especially a large company, 500 crores or more, says that they have not received a whistleblower complaint, I would believe you should relook at the process followed for gathering whistleblower complaints, because getting a whistleblower complaint is not a bad thing. Getting a whistleblower complaint just means your process works. A lot of times when people say, oh, we found 5 issues, it's actually sometimes a good thing, because one, there was a process, second, the audit worked, and you got red flags which you will fix subsequently. If you find no issue, no red flag, no whistleblower complaint, sometimes as an auditor I would question that. And we found the biggest scams, the biggest scandals happen sometimes, I'm saying sometimes, in companies where there is no issue ever identified. So then you have to check the process of reporting. You have to check the process of how these issues come to the surface. Are they giving comfort to whistleblowers that they will be kept safe, that there will be no reprimand done on them? So I think these are all very, very important points. Recently, there's been a lot of noise around insider trading, the unpublished price sensitive information. I think it's a great thing, because with all the heavy hand or the controls SEBI has put in, I find most listed companies, when I'm talking to them and there's a fraud, they're more bothered, when do I report to SEBI and how do we do it immediately? So that's a great first step, right? There's full transparency. There's an issue which comes up and you want to report on it immediately, so that there is no violation. Also, unpublished sensitive information, I know for a fact that most companies are very, very cautious on it. In fact, somebody, I remember in one of the companies I was investigating, had sent a lot of information to their personal email ID. We could not figure out from the personal email ID where did it go, or we could not even make out whether there was actually any insider trading which happened. But the fact that this person was doing it, it was, he or she was in a very critical position, was taken very, very seriously by the company. So I think there's a big change which is very positive, where boards and senior management have taken some of these areas very, very seriously. If you look at the Central Vigilance Commission, there's something called ISO 37001. If some of you don't know about it, I would recommend you Google it, look at it. If you need more data, I will provide it to you. It's a standard which looks at bribery and corruption frameworks. So as I said, there are now frameworks being prescribed for bribery and corruption, which are there. And it's very important for all of us to be aware about these. If you talk about whistleblower regulations, obviously SEBI LODR makes it mandatory to have a vigil mechanism. Companies Act also says whistleblowing is required in most companies and people have to be protected. So there is a lot of focus today to make sure that the issues, if they are existent, come to the surface, are dealt with, and processes are fixed. The goal is never to say I have no issue, not to be afraid that there's an issue, but be open about addressing it and trying to fix the issue. Obviously, then the intent comes in, right? Is it something which was done deliberately, or is that something which is done just because there was dereliction of duty, or it was done by mistake? Those are very important aspects of a forensic audit, which I'll go into, which have to be determined at the end of the forensic audit. Some of the responsibilities which have been cast by Caro, I'd like to mention that, board of directors, a lot of responsibility to give reports. reports on information, explanations, auditors themselves, because they have to report on these whistleblower complaints, audit committees and vigil mechanisms. So I think there's a lot of pulls and pushes among a whole board and an ecosystem around it to do the right thing, which is a great thing, which is report the right numbers, look at every whistleblower complaint, make sure forensic audits are done, make sure there's proper documentation, make sure tomorrow if the issue comes up again, you can hand behind a forensic audit, you are confident that the quality of the forensic audit was good, and you can disclose it. Now, what is forensic audit? Getting right into the topic. What is forensic audit is basically, if you look at the definition, it is basically an in-depth review of information, data, circumstances with a forensic mindset. And that is extremely important. Using tools, methodologies, which I'll go into some details on. Some of the biggest issues you've seen generally is misstatements, omission of information, disclosures not being done. Also, the question is, the point I was making earlier, whether it's a mistake or whether it was done deliberately. That's becoming very, very important in a forensic audit at the end to give an opinion on. And the question is, it goes into the question of willingness to repay or ability to repay in that sense. But you must have professional skepticism. I think there is no shortcut to professional skepticism. And I think you have to have an out of box thinking. Even though an audit checklist says this, I would recommend to all of us as accountant auditors, we need to keep an eyes and ears open. If something smells fishy, please do more procedures, do enhanced procedures, based on the area, whether it's sales, purchases, whichever area it is. Make sure you document enhanced procedures. If you're not comfortable, do it, and go, take it with interest. You're not just doing an audit for doing a checklist. You're doing an audit because you're giving a true and fair statement. So I think this is going to become more and more important. Some of the issues which we have seen, especially if you look at red flag accounts, and most of you as accountants would know about RFA accounts, financial statement manipulation, window dressing, diversion of funds, foreign or real estate investments, siphoning of funds, genuine loss due to internal extraneous reasons. Some of these are areas you look at from a red flag account and look at the outcome of potentially a forensic audit. So forensic audit would generally put issues under these 4 buckets, so generally at the end, you'll say, okay, was it in one of these categories? Also, one of the things a forensic audit does do is identify who did the transaction, who was responsible, what was the process which was broken. So as you identify and put the transaction and quantify the amount within these buckets, you also have to somewhere give, why did it happen? What was the modus operandi? Was there anybody which was black and white involved in this particular transaction? You have to somehow conclude on that. And then lastly, you have to talk about what is the most important thing. What were the process which were broke down? Why did it happen? And how can we ensure this never happens again? I think that's the most critical aspect. Now, what is the definition of fraud? If you look at the Companies Act, it's a very broad definition. It relates to any act, omission, concealment of fact, abuse of position. It can be committed by any person or any other person with the intent to deceive. It can be the may include the company or shareholders or creditors where there's wrongful gain or wrongful loss. So very broad definition in my mind. And as I said, I like the guidance note here because they further go into details around the issue. The RBI Master similarly has a classification and reporting on fraud. So you have, whether it's misappropriation, negligence, cheating, forgery. So you can read this, but I'm sure you can go online and get the information. I won't take too much time in the limited time I have been given to go into it in detail. But these are some areas on definition of fraud, because you can't do a forensic audit without knowing what is fraud. So please read the rules, please read the different acts, read these 2 definitions. It's very, very important. Now, how does forensic audit differ from other audits before I go into details? If you look at other audits, whether it's internal audit, concurrent audit, stock audits, they review the internal controls, they recommend improvements, they have issues more on compliance and strengthening controls, planning in advance. There's materiality, which is sometimes taken into consideration. It's governed by an internal audit statute. It's written down that you need an internal audit done. But in forensic audit, generally, it's very focused on transactions. Now you actually pick up 1 or 2 transactions and you could spend a month on it. What is the substance of the transaction? How was the money flow? Checking the bank statements, who's the beneficial owner? Where is the money finally gone? Getting into the real nitty gritty of it, pretty much like you see movies on Netflix today. Actually it is getting into the minute transaction. So it is going into the depths of a particular large transaction or a few systematic transactions which we may see. Also, it is to ascertain the facts on the ground. So sometimes you do site visits. Is the vendor or customer existent? Is the person actually a true person? person? Is it you actually go out and talk to third parties, which you don't do generally in an internal concurrent stock audit. You may do it, but you don't do it often. Forensic audit, you always end up doing it, generally most of the time. Okay, another thing is generally there is a particular issue which has happened. So you're looking at a particular issue. You already know there is an issue, either through a whistleblower complaint or a particular matter which has been raised to you by a regulator in that sense. And generally it's a very human related thing. So you're very focused on also why did it happen, how did it happen, who did it. These are standard questions which everybody has on a forensic audit. How did it happen, who did it, what process was broken, how do we ensure it never happens again, what is the amount, do we have any reporting requirement. These are very, very standard questions at the end of any other forensic audit. Obviously, if you look at forensic audits, if you look at procurement as an example, in procurement, what would you do in internal audit? You would make sure that there's a contract, there's a vendor, some parts were protected, were obtained, there was a inward receipt of material, and that supports the procurement. In forensic audit, you would look at the rate analysis. Was it right, correct? Was any kickback given? Was the rate more than market? Is there benchmarking of purchases rates? Public domain searches on the customer or vendor to make sure the third party actually exists. Is it a related party transaction? So these are very important aspects which we need to keep in mind. Another approach for conducting forensic audits. So if you look at it, I put this in 7 buckets. I'll start with what do you do in a forensic audit? These are all the tools and techniques. Trust me, this is the most important slide. So I'll take a little bit of time on this. So one is the preliminary analysis. So when you get a particular investigation or a whistleblower complaint, you will see what is the background information of a particular target, whether it's a person or a company. You will see the review of the key businesses. Very important. You cannot do a forensic audit if you don't understand the business of a company. Because if you're in retail, fintech, e-commerce, manufacturing, every business is so different. The type of fraud investigation cannot be done if you don't understand the business. Then you need to do a preliminary review of the financial statement sometimes. But the preliminary analysis is very critical to first assess whether this whistleblower complaint requires a full-blown investigation or not. And that's what is very, very important on it. Another thing which the preliminary analysis does is helps you make a planning document, which is tells you what are the different procedures you have to do. Because what I'm going to show you today is generally all the procedures done. But in most forensic audits, you may use some procedures, you may not use some procedures. So financial statement analysis is most critical. All of us as accountants, we are experts at that, but going into detail. So there are a few fraud ratios which you need to run. You need to look at the financials, the notes to accounts, the comments, the director's report, see if there's anything which catches your attention. Look at significant account balances for revenue and expenses, major items for loan utilization, do some ratio analysis, as I said, very important. Then you have to do data analytics. One of the things I've seen is that we need to go into critical information to identify any issues. Today, you have e-commerce companies. There's a new area, growing area. But can you run the same traditional sales and procure to pay kind of or order to cash kind of analytics and find issues? I don't think so. Because you could have a buyer and seller which is the same. But the only way you can validate that is through IP addresses, because you don't know if the buyer and seller is the same. You won't find the same name, and they have millions and millions of transactions, billions of transactions. If they have a bot which is replicating and creating transactions, you will never know that unless you actually have a system of analyzing IP addresses. So I'm giving you one example. There are many such examples, but analytics at that very detailed level using very advanced technology is the future. If you're just still doing analytics based on spreadsheets, I think those days are over. You will not find any pattern. The number of transactions are too many. We can use fancy terms like big data and all of that, but the reality is good SQL type of analytics, looking at large sets of data, focused on the specific transactions for that specific industry. And I gave you an example of e-commerce, which today your standard analytics will not find an issue, and you will miss most of the fraud if it is happening. So you have to pivot and change based on how the market is moving. So, but analytics combined with financial statement analysis, preliminary analysis are the first backbone of any further work you do, because it gives you some idea. It gives you if there are some related party transactions. It tells you if there's some suspicious transactions. So it gives you enough to pick up samples. It gives you enough to pick up some third parties. It gives you enough to do further work, which is phase 2, which is to kind of focus on what the matter is based on the first 3 steps, which kind of tell you what you can do. Then the next step, once you've got an identified set of parties, you've got an identified set of transactions that look a little suspicious, then you have to do background checks. So basically finding out who these customers are, who these vendors are, getting to the bottom of it, understanding what they're doing. There's enough on social media today. You don't have to go out anywhere. You can get a sense of this individual. The government has been very good. There's so much information on the MCA websites. You have to just do your homework. The attention to details to find the needle is extremely important. You cannot be a forensic auditor today if you have no attention to detail. You're just running a process and you don't want to spend time with a microscope looking at a particular issue. It's very important to have a microscope. You have to have detail, and you'll be have to be patient. Another thing is the document reviews and transaction testing, very important. So once you've, as I said, found the transactions, found the vendors you want to focus on, looking at those transactions, but not just doing a high level walkthrough, but actually, as I mentioned, going into depth of a procurement transaction. Kiske saath hai, who's it with, how much was the price paid, was the product delivered, was it of the right quality, did they actually need it? Was there already inventory lying in the stock? They can be based on this. You can come up with many scenarios in that sense. But I think it's very important to go into depth of it. Next one is email reviews. So obviously, if you have a consent forms because of data privacy and you have chain of custodies, etc., you can do email reviews on a company's servers or desktops. You can image computers. So today, most forensic auditors will take information, which is because a lot of the information is on e-form. So it will give you a tendency of what people are talking about, what people are interacting with. Obviously, very rarely will someone talk about a big fraud or a scam on emails, but you'll be surprised. You will may get an indication of a particular issue based on some email reviews. So that becomes another important thing. Lastly, it's asset tracing. Today, if you look at it, most people want to know where is the assets gone. They've lost so much money through a fraud. So much money has been siphoned out. Where is it gone? So asset tracing is another element of it. But this 7 buckets is basically different tools and techniques. Obviously, there's much more details around it. But broadly, these are the 4-5 procedures you generally focus on. And there's a lot more detailing on each one of these, trust me. Each one takes about a day to at least scope out, plan, do. But I'm just sharing at a high level with you. Okay, sorry, it wasn't moving. So the next one is what to look out for. So when you're doing this, what do you look out for? You look out for photocopied documents. What are you as an auditor looking at? If you have a photocopied document, especially during COVID, because people send photocopies of documents because you're not looking at genuine documents. Please be very careful when you're relying on photocopied documents. They could be missing documents. They could be excessive credits. They could be altered documents, duplicate payments, inconsistencies between 2 documents, delay in obtaining documents, very big red flag. If somebody is taking so much time to give you information which is standard, please be cautious. Evasive responses. If you ask somebody something in writing, you ask a management person, give it to me in writing, that's your explanation. And the person is very reluctant to put in writing, something is not smelling right. So these are just things you need to look out for as a part of any audit or any procedure that you're conducting. What are some of the challenges we face today in doing a forensic audit? There's extensive use of technology by fraudsters. As I said, I gave you the example where the buyer and seller could be the same, and people are using bots, to create these transactions. And when they're using bots to create these transactions, very difficult. Even the IP addresses at times could be different. You can't figure out, is there any circular transaction happening? Is the buyer and seller the same? Is it just showing up the transaction? Very difficult to find out in today's day and age, which is why I think you got to keep your eyes and ears open. You need to also have very good technology people in your own team, who will support you, because one person cannot know everything possibly. For instance, I always have a technology team with me to support me when I do my forensic audits, because they may know more. Sometimes they even have a law firm support us, because sometimes it's very technical, legal to interpret a contract. I need engineers sometimes to tell me about the quality of a product. So forensic audit may at sometimes also need a lot of people to surround you to make you more holistic. So never be afraid to ask for specialized skill sets to support you in that sense. Also, the fraudsters are using very innovative things. Money is transferred outside India. It comes back into India. It's through shell companies. Not much information is sometimes available on shell companies in tax havens, etc. So you got to, as I said, be patient, keep looking at it. If you feel red flags, do more enhanced procedures. Also, conflict of interest and related party transactions are becoming more and more of an issue. So I think it's something we need to actually spend more time as an institute on, because I think we all need to be trained on how to find related party transactions, which was one of the questions you asked earlier, how to check for them, how to be cautious of them, because the biggest issues happen here. Trust me, I mean, at least most of the investigation I've done, some of the biggest problems have happened in related party transactions. Now, what are the things to keep in mind while analyzing financial statements? One is siphoning of funds. That's your biggest issue, right? Someone has taken money and taken it out of the company. What do you look at? Journal entries. You look at writing of receivables, because you sold money to a customer. That customer could be a related party. Then you write it off and say, "Oh, I'm so sorry. The customer turned bad. We tried our best." They even go to the extent of filing a legal case, but it's a fake legal case because no one is actually wanting to, in spirit, go after that legal case. But there's enough documentation to show there was a contract, product moved. There's even a legal case to pursue with the related party or the customer, but that was genuinely not meant to come back. Also, intercorporate deposits is again another issue for you. So siphoning, diversion of funds is a very critical aspect when you analyze financial statements, especially around related parties. Misstatement of financials. The biggest issue I remember for many, many years was channel stuffing. Channel stuffing, for some of you may know, some of you may not know, it basically means end of the quarter, end of the year, you ship more, you recognize more revenue, maybe the product is actually not shipped, and you're recognizing huge amount of sales and receivables, which either will be reversed in the next 2-3 weeks, or sometimes doesn't even reverse for 3-4 months. I've been and done investigations where people have had 2 sets of books, and of course, it's very, very those can be large issues. So fictitious sales and receivables, inventory manipulation, work in progress. All of us have grown up with that, right? Very difficult to see inventory in pipes or WIP, because it's very difficult to physically count it, and that's where the issues sometimes come in. Window dressing of financials, making them look good end of the year or when a loan has to be issued, always a problem. Improper payment compliance issues, you pay bribes, you use consultants, middlemen, you try to disguise them by creating vendors, shell companies, or fictitious names. Again, a big issue. Compliance issues are becoming, NOCLAR is becoming a bigger and bigger issue, which we all need to be open and aware of. Operational irregularities, very complex subsidiaries, structures, selling to one entity, buying from another entity. You can't figure out, if something is so complicated that you as an auditor or an accountant cannot understand it, you definitely need to do enhanced procedures. Now, given the large number of NPA cases, what would they want? The banks would basically want that the utilizing the funds is done according to the approved purposes. There's no diversion. You're meeting the loan covenant. So I think as you investigate certain forensic audits in the banking space, I think it's very important to understand what is the expectation of the bank when they gave the loan. And once you understand what the expectation of the bank when they gave the loan is, you will be able to better test and do your forensic audit, because these are the things you need to look out for. Now, what is the impact of technology in forensic audit? And I'm rushing a bit, but I'm sure in the interest of time, but I'm sure you can come back to me at a later date. If you have any further clarification, you can get in touch with me through the institute. But in data, the biggest issue is every company today is creating data lakes. And that has become very critical for us as accountants, because then we can use the data lakes to run any sort of analytics that we would like. So for instance, millions of docs of data, it could be in manual form, it could be electronic form, and getting all that data, putting it in one system, and you having the ability of extracting it and running an OCR. That means you can actually put in keywords and search for the information, indexing that data, creating graphs, analyzing the data. Because getting data is one thing, analyzing the data and getting results based on which you act is more important. So I think getting the data lakes, using the data lakes intelligently, and then helping to fix your processes and creating findings is very, very important. So I think today, unfortunately, everything is technology based. I was speaking to my manager the other day, and he also said, everything is around technology today. So I think all of us as accountants will need to embrace it. I think it's great fun, even at my age. Every time I do a project, I sit with the technology people. I try to learn myself, because unless you learn it, you don't know what is the possibility, and the possibility is quite endless. So these are just very simple facts which I'm putting in front of you. If some of you have not seen OCRs, data lakes, I would say in the companies you work in, please try to understand from your IT people, how do they do it? Because if you understand how they do it, you will be far more effective. What are some of the evidences when you do a forensic audit? Some of the evidences are bank statements. You must have them as annexures. You must have those bank statements which are authentic, validated from the bank itself. ERP database, do you have the right version of the ERP database? As I said, in some frauds, we have seen multiple versions of ERP databases. Financial statements from public records. Email server is very important evidence. A lot of law firms actually send out what they call privilege notices or hold harmless notices or notices of not to delete any information. So preserving this information is extremely important. Shipping records, register of properties, employees, customer, supplier, competitor data, RTO records, social media. So you must rely and make sure that whatever evidence you have to support you on the forensic audit has to be airtight. Because if you do a forensic audit and there's a legal case, it will be very embarrassing to you as a forensic auditor if any of the facts mentioned in the report are not substantiated or not supported with evidence. So it's very important to read every line of your report. It is not just a very high level report which will sit on somebody's desk or just be presented once and people will forget it. It is something, anytime a forensic audit is given, it's going to be with you for the next 10 years. Assume that. So you have to make sure every line is perfect. Now, some key financial statement analysis, which all of us accountants like looking at. So some fun stuff, which is around P&L misstatement checks. So for instance, how do you find that? I think the biggest thing I look for is cash flows. I always look for cash flows from operations, check it against EBITDA or any other such ratio. It gives me a very good idea of the company's health. Non-operating income, again, gives you a good perspective. Provision for doubtful debts. Balance sheet misstatement checks, you can look at cash yields, you can look at change in reserves, contingent liabilities. On pilferage, you can look at miscellaneous expenses, capital work in progress. A lot of us as accountants, some of us do it, some of us think, oh, what will ratios say? But reality is, I can tell you, ratios tell you a really good story. It will tell you where to focus. And comparing ratios of your company in a particular industry with other ratios of similar companies in the same industry will give you a fantastic picture on what to focus. Because if there's a red flag or there's an issue, trust me, you will find it in ratios. It's a great tool. You must all use it as accountants. Now I'll give you some examples. So I have some examples to walk through. I thought no forensic audit can go through without some war stories. So when you talk about siphoning of funds, what are some of the issues? So you have high amount of related party transactions. You could have unaccounted bank transfers. You have business entity dealings with shell entities. Sometimes people even create companies floated by their friends, drivers, relatives, where money is taken out. Another thing is you have promoters sometimes or somebody who living a very lavish lifestyle when they have very bad debts. How is that possible that you have Mercedes at home or fancy cars or fancy something, and then you are actually got this whole big bad debt out there or your company is bankrupt? There could be good reasons, but the fact is it's a red flag. So I think if you just go to the next one about diversion of funds, I'll show you this a very simple example. A borrower has taken a loan from a bank. Okay, they've actually shown that they are paying off the NPA also because they're round tripped at the end of the year with a trust. Then they pay this money of 600 crores to a non-financial services company, which is a holding company of the family. And that is further then divided among company A, B, C, D, which has nothing to do with the borrower. And the money is basically gone into real estate purchases, some shell companies buying fancy houses, buying houses outside India. So it is a very clear case, and this happens, I find, whenever there's a fraud, this is a high probability of something like this having happened at some point in time in the company. Another thing is analyzing accounts payable and accounts receivable movement, very important. So if you look at this over a period of 2017 to 2019, and these have just put in numbers, you'll find loan from banks have gone up from 550 to 1015. You find receivables have gone up from 202 to 1035. But the fact is, this should give you red flags. Why are receivables going up so much? Why are the payables going down so much? Are people paying off related parties? Are these receivables genuine sales? So there can be hundreds of questions you can ask at any point of time around this. This is a very clear example of, for instance, directors living in chores. You have drivers, you have people's help at home, or any secretary who's becoming a fancy director. When you go into a site visit, you find it's a chawl or something. There's a red flag. But there is never any harm. You have very famous big directors staying in places, never hurts. Go check it out. If you have a doubt, and you'll be surprised in investigations, we found these many instances. Another issue is a borrower, as I gave you an example, has and outstanding, but is having, if you look at social media, going to different holidays, going to different fancy countries, going in chartered planes. How is that possible? That's a red flag. You need to look out for that. Another thing is fictitious transactions. Where there's fictitious transactions where finished goods are sold at rates substantially lower than procurement rates. There's circular purchases and sales transactions happening, collusion with suppliers. So all of this, I think, is areas where you need to just keep your eyes open, because this is how fictitious transactions happen. They're fake work orders. You show high sales when actually the sales don't happen. They're fake customers. Sometimes you have fake vendors. You're managing the year-end earnings. Trust me, as accountants, it is possible. So it's important to be careful. Another area is fictitious circular purchases. So as I joked with somebody many years back when I just become an accountant, I was saying you can actually build a company out of nothing. So that means if you have 100 crores, you can actually move 100 crores around between a customer and vendor with a shell company in the middle. And you would never know any different, because I could keep adding to that 100 crores. You're buying 100 crores, you're selling 100 crores. So that's what it is shown in this one company, where there was actually a forensic audit done, where you can see Group X selling to ABC, ABC selling to Group Y, and then money coming back. So you can see the circular transactions and how it actually flew. A review of inventory vis-a-vis sales, I've already mentioned, is something which you have to be careful about, especially on the turnover ratios, etc. It's just one more example in that area. I'll take a minute on this, but basically there are basically about 8 categories which you need to be careful of, and you must have an audit plan or a plan to address this. Procurement, what is the thing you're afraid of? Kickbacks, creation of ghost vendors, manipulation of agreed rates. In bidding, what do you care about? Where the L1 is manipulated, L2 is getting the order. Some vendors are invited, some are not invited. Capital expenditure, as I said, capital whip is another area you've got to be very careful of. In today's day and age, you hear of a lot of treasury management issues in COVID time, because a lot of things are happening on photocopies, where money is being remitted out of a company, sometimes by the finance team, where money is left, and it's because of weak controls, and sometimes the money never comes back. In that sense, sales and collection, I said, fake customers, creation of customers to show great revenue, great growth, when actually none of that exists. Inventory is an area you've got to be extremely careful, and I think COVID has really brought up some of the issues. How do you track inventory, count it? Because of COVID, people couldn't travel, couldn't check warehouses. A lot of issues are coming up now as we see it in this area. Anti-bribery, as I mentioned, NOCLAR, the non-compliance of law and regulations, as we all know, bribery and corruption, very important to look at payments which look suspicious, because tomorrow you could be questioned as an auditor that didn't you see this was an odd payment or an odd transaction. And lastly is finance and accounts. The whole finance and accounts process, system, people doing it have to be looked at. I think that's it from my side, Anil.
Thank you so much, sir. Can you hear me, sir?
Yes, I can hear you.
Thank you so much, sir, for such a marvelous presentation relating to the subject. We have with us a few questions for you, sir. First question is, sir, give the volume of the transactions, how the forensic audit is concluded for this financial year. Can we conclude the forensic audit based on the samples taken, or what if the real issue that could be fraud lies in the samples not taken as by us?
So in my mind, picking samples which are subjective is high risk, like we used to do in the old days, Anil. The reality is, if you use analytics and fraud analytics and look at the full universe of transactions, and based on those transactions, you pick up samples, you will have much more confidence to know that you have not missed something, because the analytics covers 100% of the transactions. If there is something odd, it will show as a red flag and come through to you, and then you pick up the samples, and that's how you build confidence. So even sampling methodology is very, very critical in any sort of audit. So I would recommend that you can't just pick up subjective samples and say I've met my requirement. You have to run analytics, you have to cover 100% of this the universe, and then pick up your sample, and your sample should be able to hold. If you find issues, you have to expand your samples and pick up more samples. So I think Anil, it has to be a well planned out process to collect samples. It's not like just randomly picking up samples like some of us used to do many years back.
Ji, sir. Ji, sir. Another question is, sir, frauds are more inherent in private company and people near the power center. So could you please tell us on the finalization of financial statements, how to deal with the frauds if there are some frauds after finalization of accounts?
I think if there are frauds, of course, after finalization of accounts, sometimes you can get to know of an issue between finalization and signing by the auditor or the board accepting it. I think as soon as you get to know of the fraud, you need to immediately get in touch with the audit committee, the board, and inform them of the same. And obviously, it's easier in a public company or a large listed company. They are right. In a private company, it becomes a little bit more difficult. But I think there's always an option of resigning. There's
Yes.
always an option of informing the institute, taking guidance from the institute. I think there's so many people in the institute who are mentors of us as CAs. When we have a problem and there has been a mistake, or there has been a mistake, but we've got to know, I think it's always good to do consultation. I do that even in my firm I work in. We always make mistakes, but it's always important then go and consult with someone senior. When you consult, you will always do the right thing at the end. Don't keep it under the carpet.
Yes,
So I would
yes,
say you have
yes.
a problem, please come to the institute.
So these days, many auditors do systematic audit and checks and balances. Whether they omit or forget, take very few samples to examine critical documents, context analytics, and critically examine the work orders, rate changes, work change requests, etc. These days, I guess examination of documents are slowly vanishing out of the audit scope. Sir, can you please elaborate or give your input, please, in regarding this?
I would say in a good audit, these old practices of taking the document should not go away, because analytics is on the universal data, as I mentioned earlier. It picks up samples, but those samples you still have to go down to the work orders and the documents and the supportings, because I don't know how you can get comfort just looking at the samples and a voucher without looking at all the underlying documents and doing all the procedures which are prescribed. So I would recommend, when you have samples, please do them thoroughly and go down to the underlying records. I still do it, so I think everybody should do it.
So there is one question relating to this. What is the auditor's role in implementing forensic audit in the main audit report?
I think there's an increasing pattern where if an auditor, as you know, there's a reporting requirement by the auditor, right? There's very set requirements. If it exceeds a certain amount, you have to report it. If you find the fraud, you have to report it. If the management informs you of the fraud, you have to make sure the forensic audit is done properly. So there are certain rules which have been prescribed. I think in light of that, the auditor's role should be very clearly as a part of their procedures. If they find a fraud, I think they should immediately inform the senior management and the board and get a written response from them. If they find that the written response is not adequate, then obviously they have the reporting requirement, which is mandatory. If they find that the management is conducting a forensic audit, then they should not just stand back. They should prescribe what they would like covered. Because the biggest mistake I sometimes find with auditors is they let the company do whatever they want and give them a forensic audit. You must ask what you want, and you must make sure the forensic auditor is also some authentic firm that you trust. It's very important that, because is the firm the one you trust, is the people there you trust, are they doing it in an objective manner? These are very important things, which, so an auditor cannot just take his hands off saying a forensic audit is now being done, I'll wait for the report to come. It's your duty to wait for it, and once you get the report, you may want to expand your procedures and further do work and not just rely on the forensic audit 100%. So I think it is all dependent on the subjectivity. That is why it's an audit partner, right? You're
Yes,
signing a document.
yes, sir. Yes, sir. Yes, sir. So last question. We hereby requesting you, sir, there is one request from the few members to please also discuss or elaborate the point related to the keys of identify fraud. How to identify, matlab, tips for to identify the fraud in forensic audit.
I think the tricks, some of them I mentioned in my presentation. I'll just
You
give
have
one or
already,
two
yes.
examples. I've already mentioned where, whether it's procurement or whether it's employees or whether it's sales. I've given some tricks, but you can catch up with me separately after this, and I'm happy to share further detailed documents. Not an issue.
Yes, yes. So thank you so much, sir, for the wonderful deliberation. You have precisely elaborated as well as they explained the various tricks as well as tips and how to find out the frauds and how to deal with them and how to tackle with them. And it was really appreciable presentation, and you have justified with your presentation, sir. And from the core of my heart, thank you so much, sir, for
Thank
sparing
you.
your valuable time and acceding to our request on a very short notice for this particular topic, which is a very important topic. And hope we will also conduct a few other sessions on the same topic in the near future. And you will be available. You are very kind enough that you have acceded to our request on a very short notice. Thank you so much, sir. Thank you so much on behalf of Committee for Members in Practice of Institute of Chartered Accountants of India. Thank you so much, sir. Thank you.
Thank you so much.
Thank you so much.